In today's video, we're going to discuss balance, how to achieve a better balance in your portfolio between growth and value. As you can see, I lost $7,000 today, and that was due to the Dow Jones being down 1%, as you can see at the top, the NASDAQ being down 0.18, and the S&P being down 0.64, which is right in the middle between growth and value, the NASDAQ being growth and the Dow being value. So we're right in line with what the Dow Jones did. We actually lost a little bit more than the Dow Jones. The Dow Jones is down 1%. We're down 1.15. So this wasn't terribly out of line with the market. It's just that you can tell old value names were getting crushed today, and my portfolio got crushed too as a result. We earn over $100,000 per year in dividends, as you know, here on this channel. But you have to do this responsibly. All the subscribers that I am in contact with at this channel are trying to have similar amounts of passive income, if not more, but they have to do it responsibly. They can't buy names that go sideways to down and decay like we discussed in our past video last night. Go see our past video if you want help on diversification. You also have to keep in mind balance between growth and value. So yes, we're outperforming the markets. We're up 16%. The Dow Jones is up 0.6. The Nasdaq's up 18, and the S&P is up 7. So the Nasdaq is beating us by a hair right now, up 18% versus our 16%. And again, that's because value has taken a hit for me lately. And CLM, if we go through our portfolio from the top down, you'll see the biggest culprit of today's losses was CLM. That is the value play for Cornerstone. Cornerstone CLM matches the S&P, and CRF matches the NASDAQ, but it's not exactly the S&P. It's more like the value fund, and CRF is the growth fund. So 1.43, we're down in CLM. That's 3,000 of our dollars. So almost half of our money, $7,000, was due to CLM, but that's value. And as I scroll down the list here in the portfolio, we go slowly. GOF has some value and some old, it's like bonds and value. That was down 1%. And as I keep scrolling through very slowly, I see that, some of these names weren't down as bad, but BDJ down 1%. That's got old value names. Clip Tech, it was down fractionally. I'm seeing some other, BST fractional. So growth was hanging in there, doing pretty well. Raw, that's real estate, and has a 14% yield roughly. That has some old value in it. Anything that's old, cyclical, real estate, energy, banks, all these guys were going to be hurting today, but things that were growth related outperformed. As we keep scrolling down, Tesla was up. IEP was even up, and that's had a mind of its own lately due to the short selling from the Hindenburg. So you keep scrolling down. What do you see? Metals, Yuan and Devon down 2% and 3%. So that's value. Those are old value plays. And we keep going. EDF, that's emerging markets. I guess that kind of bucks the trend. Emerging market bonds. SLG, real estate, that was down 6%. So my raw was down 1%. SLG was down 6%. This is what I'm seeing here. Metals, BHP, again, down 2%. So the biggest movers, SJT, energy, this is our oil trust. It pays a 10 to 20% dividend. It varies, but it's 100% maintenance, so I keep it a small amount. So all of these value plays and old cyclical plays seem to have gotten hurt today, whereas growth hung in there pretty good. So it poses the question, do I have the right balance of growth versus value? Well, I try to stay in between growth and value. The Dow Jones being the ultimate value index, the NASDAQ being the growth index. So I'm always trying to do the S&P, trying to match the S&P, which is kind of right in the middle of the two. And I think I've achieved that. Today, yes, I was down a little bit more with the value plays. But if you look at my performance and value again, you see that I'm doing much better than the S&P, just not as good as the NASDAQ right this second. So would I want to be in more growth plays then as a result of this? I don't think so. I think growth is the way to go in 2023 and 2024 because interest rates are going to start falling, and that's conducive for growth companies who need startup loans and lower interest rates on those loans. So I do see growth outperforming value, and that's why Schwab D and a lot of those other names have been getting hurt this year because those were the old value plays and defensive plays. I do see how growth could outperform that, but I don't want to get overloaded in growth because if we have an overall down market, then growth is going to hurt you more than value because it's a higher beta sector. Tech will move twice as much as a value name if you have a down market day. So I just want to show you a heat map really fast too of the market. As you can see here below, we have tech in the green, and we have most of the red here being these old industrials and cyclical plays. Energy was in the red, industrials, real estate. The only thing that you see green are technology and certain growthier areas of the market. So I thought that this goes in line with what my portfolio showed. Everything in the portfolio that was down was value, and everything that's up or down in this heat map seems like everything that was green was tech and everything that was red was value. So that coincides with my argument that today's down day was nothing to be worried about. A lot of people have been emailing me. They're freaked out about Cornerstone. What's happening with Cornerstone? To me, Cornerstone this is just business as usual for Cornerstone. After around its X dates, which we just had, it gets a little weird. And plus, again, it was down today with value. Now, if we scroll over to this chart of Cornerstone and zoom in to its large chart, you'll see that everything is doing fine for Cornerstone. It's just chopping sideways, kind of like the S&P is doing. See, if we go look at a chart of SPY, you'll see a similar pattern of just a sideways chop here. See, we're just going sideways. Yes, it's trending up a bit, the SPY, but it's still just a sideways chop. And as you know, when you have a sideways market for Cornerstone and these other high yielding dividend ETFs, you're going to see sideways decay. And that's why I made that video last night about diversifying away from Cornerstone with names that move upward, left to right, so that you get to offset down days. Not like today, because today was more of a value situation, but to where you offset that sideways decay. That's why you want the diversification. Now, for the purposes of today's video, we're not really talking about diversification so much as we're talking about balance. Yes, the two themes are similar, but you could be well diversified into all the sectors, but be overloaded with too much growth instead of value, or vice versa. So you probably want to always keep a 50-50 balance of growth versus value. That's what I've done with Cornerstone. That's what both funds allow you to do. One fund is growth, CRF is growth, and CLM is value. So they allow you to achieve that perfect balance anyway. If you go to my allocation and risk in my portfolio, you'll see that we have basically we have most of our money in large caps, and 58% is in CLM and 57% in CRF. So they're pretty equal there, and that's my goal, is to have Cornerstone be the literal cornerstone of my portfolio, no pun intended. And they both give you that even balance of 50-50. And today, tech, CRF, growth outperformed value. So it's pretty simple. Today's video is nothing deep. It's not like this is some principle or far off theory that you've never heard of. This is something that everyone's aware of, growth versus value. But I think it's important that you be conscious of it in your own portfolio, because it can really throw off your performance, as you see by a day like today. This is all value. And yes, again, do you want to have more growth? Not really, because in an overall down market, a rising tide raises and lowers all ships. A rising tide raises all ships, and a falling tide lowers all ships. So when the market falls, you're going to see the higher beta names fall way more than the value names. So I keep an even balance at all times. So go through your portfolio and see if there's any improvements you can make. Weed out some of the extra exposure you have to value or growth if you can. as I'm looking at my portfolio, I don't see a need to adjust anything. I mean, I'm going to keep these energy names the way I have it because I have to have energy exposure. All these other value names that I have, I have to keep on. And you know, as you saw in my allocations, I'm pretty much even 58%, 57% because the Cornerstone funds allow you to do this. But if you don't have Cornerstone, take a hard look at your portfolio, because maybe today you did okay if you had a lot of growth, but some days you might do worse if you have a lot of growth, and you want to achieve that balance between growth and value. So I hope this video helped. I didn't mention one of the major goals of this channel for anyone who's new to this channel, but in our estimated income, this number that we have here, this 118,000, it's designed to pay back my margin debt of about 300,000 in 3 years. So if my margin debt down here is, let's say, 247, then in less than 3 years, theoretically, this should be paid back. So my debt will go to zero and my account will jump by 300 grand due to my estimated income of 100,000. And this is how you become financially free. You buy dividend funds that not only allow you to pay your bills and live financially free, but they qualify to banks for loans. That's the whole purpose of this channel. Every other channel that I've found on YouTube, especially when dealing with finance and trading stocks, they never tell you about this fact that no matter how successful you are in trading, which most people aren't, 90% of traders lose, no matter how successful you are at trading, you can't qualify to banks for that. So at this channel, we're focused on getting qualifying income and buying as many dividend yielding names as possible so that we can live financially free, but you have to do it responsibly. You can't just have a bunch of income like this, 117,000, and then expect to pay off your debt of 300,000 in a few years. You can't just go about it like this, because what if the market falls? You know, you can get into a margin call. So we talk about all different kinds of strategies to eliminate this risk of margin calls, including yesterday's strategies of diversification and today's strategy, which is balance. You have to have a proper balance. You cannot be all tech or all growth, and you can't be all value, as you've seen by today. You could probably do well in life if you kept all value, but some days you're going to have negative fluctuations in your account that if you were playing with a lot more margin than me, could set you off closer to a margin call. So you have to keep this balance going with margin or without margin. I just choose when using margin to get the optimal performance that I can, because we don't want margin calls. And again, even without margin, you want performance. And the way to get performance is to tie things to the indexes. You don't just buy a bunch of dividend names that have high yields. They have to be tied to the indexes. But when you do tie to the indexes, like I've done, make sure that you have a balance between growth and value. So anyway, I think that'll do it. Leave comments in the section below if you have any questions on this video, or if you have any other ideas of videos you want me to make in the future, if you have any other funds you want me to cover. Okay, and I'll talk to you soon. Thanks.